Welcome to the REI Foundation Podcast, where we cover all the steps and strategies to make your real estate dreams a reality. Now your hosts, Jason and Peely.
Hi, everybody. Are you tired of losing leads? Well, then I want you to go back to episode 157. We interviewed Tom Caffarella, and this guy is a monster at finding leads, keeping leads, and converting leads.
And Tom has a special offer for you. He is now giving away his simple 3-step process for how you can more than double your investment business this year by building a brokerage team without taking up any of your time.
What?
And if this sounds awesome, which it does, you can find all about it at www.buildateamthatbringsyoudeals.com. Again, www.buildateamthatbringsyoudeals.com. Everything you need to know, go check it out. Well, hello again. This is Jason with the Real Estate Investing Foundation podcast. Thank you again so much for joining us today. And again, if you like what you hear, please go to iTunes and give us a 5-star rating and review. And you can always find this also on all the other platforms, Stitcher, iHeartRadio, and now find us also on YouTube. The video will be up and coming today. So we're very excited for our guest today, Yonah Weiss. Yonah is going to talk about a topic that we haven't covered on our episodes after almost 200 episodes, is cost segregation. Why this is going to be an important topic for you to understand, because once you understand it, you're going to be kicking yourself that you haven't done this on your portfolio quickly before. So Yonah, thank you so much for being on the show today.
It's a pleasure. Thanks for having me. And congratulations. Sorry, Peely can't join us, but obviously for a very good reason.
Yes, that's right. Yep. We just had our 3rd addition to the family come over the weekend, and we're blessed. Happy and healthy baby boy. So thank you so much for that.
Thanks.
And a little bit more about Yonah. So Yonah is a powerhouse with property owners' tax savings as a business director at a national cost segregation leader, which is Madison Specs. Yonah, in his short career, has assisted clients in saving tens of millions of dollars in taxes through cost segregation. And over the past 12 years, Madison Specs has done over 12,000 cost segregation studies, and I believe with the new tax code, it's probably going to double pretty quick.
Right.
Covering all 50 states and resulting in over $2 billion in tax savings, which is absolutely why we're so excited to have you on the show today. So, Yonah, welcome to the show, and tell us a little bit about. Generally, we talk about how'd you get into real estate investing, but for you, how did you find cost segregation? Where did it really stand out to you?
You know, it kind of fell into my lap. My background is not in taxes and is not in engineering, which are 2 components to cost segregation that are integral. My background is teaching, and I was very, love real estate and everything to do with real estate. And this company, Madison, which is really known for, especially in the tri-state area, as being a title company, Madison Title. And one of the branches that they have is this cost segregation firm, which is one of the companies under their umbrella. And I really got introduced to the company, and they needed someone to take a more business role in reaching out to new clients, helping to spread the word about cost segregation. And that, I kind of stepped into that, and it's been an amazing ride. So I've been able to, do a lot of these, speak to amazing people like you and your network, and, just kind of teach the world about an amazing tax strategy that just really gets overlooked. And I think it's one of those things that either you know about it or you don't know about it. And unfortunately, there's probably way too many people that don't know about it. And so I'm, coming on these to kind of change that.
Great, and we love that. And so before we jump into the specifics, why don't you give us the Real Estate for Dummies high-level version of what cost segregation is, and then we'll dive into how we're using it today.
All right, so for dummies, we'll do like this. Cost segregation is, first of all, a weird name, right, that the IRS gave to this amazing tax strategy. And it has to do with depreciation. Depreciation is a deduction on your income tax for any property owner, investment property or business property owner, has a deduction called depreciation, which is based on the value of the property. Cost segregation allows you to take accelerated depreciation deductions, meaning instead of depreciating a property over 27 and a half years or 39 years for commercial, you get to actually take the benefits within the first 5 years, a whole chunk of that, not all of it, but a whole chunk of those benefits in the first 5 years, by bringing in an engineer to the property to take a survey and find all of the assets in the building and outside the building that depreciate over a faster life. So Reader's Digest version, it's a great tool to increase your deductions, lowering your income tax liability, which potentially can even go all the way down to zero, and increasing your cash flow, using that money that you would have given to the IRS and spending it, reinvesting it in another property, and keep it going.
So the IRS always wants our tax money. So why do they have this? Why do they want us to do this?
It's interesting. Yeah, it's an amazing thing. I'm not sure what the mindset, why they initiated this. It has taken a number of developments over the years. It was originally initiated about 30 years ago, and had a different name. It was called component depreciation or segmentation. But regardless, they really, there's got to be a way that they're making money out of this. But it turns out that they highly recommend that all properties do this process. And unfortunately, they don't enforce it. They don't tell you have to do it. And I actually just read a book, Tom Wheelwright's Tax-Free Wealth, a great book, highly recommended. One of the Rich Dad series is actually, Robert Kiyosaki's accountant. So he says over there an amazing quote I just read last week, and I just want to share it. He said that most people, the IRS knows that because of the laziness of people, real estate investors and their accountants, right, they're not going to tell people they have to do this, which in turn, winds up more revenue for the U.S. Treasury. So it's a balance. They want you to do it, which will give you more cash flow. And in turn, according to that logic, it helps the economy. Obviously, we know that real estate investing helps the economy, helps people find housing, better housing, helps people give more people jobs. And it's better for the economy, so they give more tax benefits for people who are helping the economy. And I guess that's what it sums up in. And, if it, just based on my logic, I never heard this from anyone else, but, if you look at the new tax reform that just happened, which there are a ton of benefits for real estate investors, which we'll get into a little bit. If you look at Congress and House of Representatives, the Senate, over 80% of them are real estate investors. So it actually it makes pretty good sense that they're going to make and pass laws that are going to benefit real estate investors. But that's just my logic.
That's a great point. So let's talk about now a little bit more in terms of the cost segregation. So if I'm a real estate investor, can I use a cost segregation study across all spaces? If I own, commercial real estate or, retail, office, industrial, or if I own a multifamily, single family house, what can I do this on, and where does it not make sense to do it?
You can do it on any property except for your primary residence. So, right, because there's no depreciation deductions on your primary residence, but any investment property across all asset classes, you can do it. There are going to be some types of properties that are going to have more benefit than others based on the 5-year assets, the 5-year life assets, which we'll get into a little bit maybe, that maybe we'll take a step back and see what exactly the process of the cost segregation of, reallocating assets to faster depreciation lives. So let's take a step back. We mentioned before that a property depreciates, if it's residential, multifamily, single family, depreciates over 27 and a half years, right? Commercial properties, and that's everything else, like you named, office, industrial, retail, you name it, depreciates over 39 years. So what that means is that when you buy a property, you take the value of the property, you subtract land allocation, because land does not depreciate. So a certain percentage of that value, when you buy it, has to be given over to the land. It's usually around 15 to 20%, pretty standard. Some places in the country, it's going to be even higher. some places less. It really depends on the state, county. But once you have that basis, it's called the depreciable basis, the value of that property, you go ahead and take that depreciation deduction over the next 27 and a half years, one fraction of that, okay? So simple terms, you buy a property for $27.5 million, okay? Just keep it round. And that's after the land allocation. Let's say you bought it for $30 million and you made a deduction, for the land of 2.5. You left with $27.5 million. That means every year for the next 27 and a half years, you can take a $1 million deduction from your income tax. Okay? That's called straight line depreciation. What cost segregation does is it uses the audit guide that the IRS put out that says there are things in the property that are called like personal property that are not actually part of the structure of the building, but rather the things in the property like appliances, carpeting, certain electrical, wall coverings, certain special purpose plumbing, all kinds of things, outlets, things that are not part of the structure but are within the building, right? So those things actually depreciate over 5 years. When an engineer can come who's, proficient in this tax code and takes all of that information and adds it up and says, hey, you know what we found in your property, there's about 20% of the value of the building can be reallocated to faster depreciation life in this 5-year property. So you can go ahead and take that deduction within the first 5 years instead of spreading the whole thing over 27 and a half. That's in a nutshell how cost segregation works. So that being said, there are certain properties that are going to have more of that 5-year property. I'll give a classic example. A health facility, let's say like a nursing home, skilled nursing facility, okay? There's a ton of special purpose electric, the beds, they're very expensive, right? All kinds of equipment. And that's in every single room, right? All of that stuff has a tremendous amount of value, and therefore the property, when it's bought as a whole, especially when the business is involved in the buying of the property, which happens often in a nursing home, a lot of the value can actually be allocated to that equipment and that furniture and appliances and stuff like that, which means that there's going to be a much higher percentage of that 5-year property. For example, 30% or 40% even can be allocated to that 5-year property. And so they're going to get a lot more benefits up front.
Wow. So incredible use for this. And if you're looking today, to me, it would make sense that, so on the other side, if you had a single family home as a rental, it may not be the best use just because it'll
right.
But now if you're talking about multifamily, this can be a really point. So walk us through the process. I say, okay, I buy a 12-plex or a 12 unit, and I say,
right.
oh, well, maybe I should just call a segregation study. I call you up and put it in front of you. What's the next steps to a process here?
Yeah, sure. You call up, myself, or, there's plenty of other firms out there as well, but usually accountants don't do this, so you have to contact a firm like ours unless you have one of the large accounting firms that would have engineers on staff to do this in-house. The next step is we'll provide what's called a feasibility analysis, or like an estimate, which we provide complimentary, free of charge, no obligation, which will show you the numbers that we project you'll be saving, the taxes you'll get, the tax benefit you'll have from doing a full cost segregation study. And that, is a great way to just make an educated decision to see if that's going to work for you, right? So that's the first step that we'll do. And that generally we need very minimal information to do that. So we'll need like the address, which then we can pull public records and get like the square footage, and the purchase price, which is going to establish the value, like we said, the depreciable basis. Then we'll need, when you bought it, right? Because that's also going to establish when you're going to start depreciating that property. So based on those things, we can make an estimate based on the thousands of properties we've done similar to those. Mm-hmm. And we'll give you that. You can make an educated decision, see if it makes sense. Now, just our kind of benchmark to see when for sure it's going to make sense. I like to say a property purchased over $1 million is usually going to have tremendous benefit. Okay, enough that for sure it's going to outweigh the cost, and there is a cost involved in running a full study. But over $1 million property, the benefits are going to far, like 10 times at least, 10 to 20 to 30 times outweigh the cost involved.
Wow. And so if I was to buy maybe a multifamily that had a repositioning factor on it, and I was going to go in there and spend $5,000 a unit fixing up the property, and I'm going to do that over the next 6 to 9 months, would it be better for me to engage you day one or wait until I'm done with the renovations?
That's a great question. And it depends on two things. The first thing is, really, are you going to, and this is really a step back. When does cost segregation work? For who does it work, right? When does it work? And I would say it's not always going to work. And one of the main deciding factors is this is going to affect your overall tax situation, your tax strategy. Now, if you're not making money, right, if you don't have a tax liability, and there are people that are not, and their tax structure just doesn't function that way, then it doesn't make sense to have extra deductions, right? So the first deciding factor is, are you making money to be able, you want this extra deduction to offset that. That's the first thing. If that's so, then the best thing to do is to get in there right away. Why? Because you can actually double dip when you're doing renovations. You can get the accelerated depreciation based on the property the day you bought it. Okay, so let's say you bought a property for $1 million, right? You can go ahead and run the cost segregation study right away. Claim those benefits. The engineer will take and assess everything in the property. Then you're going to spend the time, like you said, upgrading the units, right? Disposing of stuff, putting in new, cabinets, what have you, putting in new tiling, whatever it is. You can actually go ahead and write off. When you dispose of those cabinets, you can write off the value that's left in it. There's still going to be some value. It's not going to be the full value, but there's some value left in that. You can write that off. And then when you put in the new stuff, you can do the cost segregation again on the additional. So when you're spending a few $100,000 in capital expenditures, in improvements, it makes sense to do the cost segregation actually twice. Once when you buy it, and then again when you finish the renovations at the end. Especially, and I say especially when it's going to cover 2 tax years, right? Because you can actually you can get the benefits in the year that you bought it, and then let's say you're going to spend 6 to 9 months, like you said, and by the time you finish, it's going to be a new tax year. You can do the accelerated depreciation again in the new tax year.
So if I'm doing this study and I'm still stuck a little bit on the single family house topic, if say I have 10 or 20 single family houses, can I do one study across all of my houses? Would that be a format where it may work for some investors?
It could be. It really depends, again, on the basis. We're going to look at the overall basis now. It depends if you bought them as a portfolio versus as you bought them individually one by one. The difference is that you're going to be depreciating each one separately.
Got it.
So you're actually going to have a engineer come to each property. And when you're dealing with single family homes, each property is uniquely different. Unless you're developing. And I have a guy right now who's developing, 20 townhomes on one street, and they're all identical, right? So in that case, it's going to be very easy and similar to multifamily, in which the engineer will only have to go into like 1 or 2 sample units, right? Let's say a 1-bedroom unit, a 2-bedroom unit, a 3-bedroom unit, and then use those findings to apply to everything else because they're identical. Whereas when you're dealing with a portfolio of single families and they're all unique, you need to go into each one, so it's a lot more tedious. It's going to be a lot more work involved on the engineer's part, and so therefore the cost involved in doing the studies is going to be, each house is going to be its own study, as opposed to a multifamily where you have, a 20, 30, 40, 400 unit building. The cost is going to be the same. Whether it's a 20 unit building or whether it's a 400 unit building, the cost is pretty much the same.
Gotcha. And now if we look at it from a real estate investor's perspective, what would you categorize as the top 3 or 5 benefits to an investor for doing this?
I'd say, and maybe you want to share your, because you've done it yourself, so I'd love to hear from you. You are the investor who's used it, so I'd love to hear from you after I tell mine.
Sure.
Or maybe you want to go first.
No, that's you're the professional here. I'm just trying to keep the camera on and not mess things up.
But I'd say the number one reason is cash flow, and that's what real estate investors are dealing with. Appreciation of the property and cash flow are usually the two top things people are looking at when investing in real estate, right? Whereas the tax benefit is maybe a third, fourth kind of thing down the line. However, cost segregation actually increases the cash flow. So even though it's on the one hand, it's a tax benefit, which is kind of lower down on the pole, but it increases the cash flow because it's going to lower your income tax liability, lower down the check you got to cut to the IRS, and many times, like I said before, nail it down to zero. You're not going to be paying any taxes if you're doing it properly with the right strategy. All your money that you're making and cash flowing from your properties, you're going to put back into them or put back into another property. I'd say cash flow is number one. Another benefit, it helps with the overall, I'd say tax strategy, right? In compliance with the way that the IRS is looking at things. In fact, when you're doing a cost segregation, people often ask me, does this raise a red flag with the IRS doing a cost segregation? And the simple answer is no, of course not, because you are depreciating the property in the right way the IRS wants you to do it. So it's actually going to be more beneficial. So that's a second thing that's going to help you. I'd say a third thing would be, let's see, trying to kind of stuck over me. I got to prepare a little more. But let's just think.
Well, before we jump on that, is there any point that if I own a property and today I'm listening to the podcast and I'm like, man, I've owned this 10 unit for 5 years now. I just did a cost segregation study today. Well, can I still do this study 5 years after owning the property?
Absolutely. That's a great question. And so yes, you can. You can do it retroactively, and actually you don't even have to open up previous year's tax returns to do that. There's a simple form that we actually help as part of our service to fill out for you, which is called 3115-3115 form, which is a change of depreciation. You can tell the IRS, hey, I've been doing it straight line all these years. Now I want to change that and do it in the segregated categories of 5-year, 15-year, 27-year property. Just came to me a couple more reasons why you might want to do it, which is something I mentioned before, kind of in passing, about when you're doing improvements. So when you, like I said, you can do the cost segregation immediately upon purchase, and then when you do the renovations, you can write off the stuff that you dispose of, right? Now you can't really write that off unless you've first given a value to them. So that's what the cost segregation actually does. Since we're giving a value to every single asset within the property, you can now come to the IRS and say, I've provided the value of this X, Y, and Z. The cabinets cost this amount, allocated the cost to that, and the wiring to this, the tiles to this amount. Now you can write it off because you've already established what the cost of those things are. Whereas when you buy a whole property, you don't know how much to allocate to shelving or to an oven or what have you. When the engineer comes and gives the price to those things, the cost to those things, you can now come and say, now I can write the value off.
And so I own this property, and maybe it's a syndication, and I have a hold period for 4 to 6 years.
Okay.
And I do this cost seg study, and we're broken down to different years. If I end up selling it at year 2, what happens with this depreciation that I've pushed forward into 5 years?
Okay, so that's a great question. And this is one of the most deterrents that people don't want to do cost segregation or don't, in general, is what's called depreciation recapture tax, which is the most dreaded tax that is out there, right? You're buying property.
They're all dreaded, right?
They're all dreaded. But when it's a lot of times it comes unexpected, right? Especially, and there are a lot of people who don't even take depreciation for some reason or another. they may not even know that they're allowed to take depreciation, or may not even know that they should take depreciation. They're, especially someone who's doing the books on their own and they're not engaging an accountant to do it for them. There's plenty of people out there that want to save money by, doing QuickBooks or on their own or what have you, and they're missing out on depreciation. Now, the IRS doesn't look at it like that. They're going to assume that you took depreciation whether you took it or not. So when you go ahead and sell a property, you have to pay a tax on the depreciation deductions that you took. Okay, so the tax that you're paying is going to be lower usually than your tax rate had you paid that money originally. So in the end of the day, you're going to benefit either way, because you have it, what we call the time value of money. Having $1,000 in your hand today is worth more than it is having it 5 years from now, right?
Yeah.
So the depreciation recapture tax is going to be, it's capped out at 25% on the amount that you took up front. So that's one reason. So that when you do cost segregation, there's two things that happen, because the property is now allocated into different asset classes. There's the building, which depreciates over one category, and then there's the personal assets, the 5-year property or 15-year property, which is land improvement, depreciate at a faster rate. Okay, for anyone who wants to know what these are called in a technical term, the building is called 1250, 1250, and the personal assets are called 1245. Those are the code sections in the tax code that discuss these different properties. So you might see that come up in discussion, 1245 property or 1250 property, if you're reading up on cost segregation.
Yeah,
they're actually taxed at different rates. The depreciation recapture is taxed at different rates for those two assets, which is important to note also. The building is taxed at like you said, capital gains rates, which is capped at 25%. It really depends on your income tax rate. And whereas the other stuff is actually taxed at your normal regular income tax rate.
And I'm not going to ask the cost of a study, because it's not a good question, because there's a cost first. Every office building with 7,000 offices versus a duplex, it's going to have a different cost. But the way I looked at it is the cost of this study, does the benefit of the study outweigh the cost? And that's usually how we take it from my perspective. And that was helpful for at least looking at what I was getting back from it. And it greatly outweighed the cost of the study very quickly. So I would definitely be looking into this if I'm listening to this podcast and I have properties that I'm holding. And of course, as you spoke about, the whole pattern is very important too. You don't want to get stuck that you buy a property and you do this cost seg study and you're selling it 6 months later. It might be a quick turnaround for you to do this. So we've had this new tax code come into place. What is now the change, and how is that affecting the use of cost seg studies?
Right. So the main change that took place with the tax reform, the Tax Cuts and Jobs Act, for anyone who's watching this, 10 years from now or whatever, right? We're talking about the end of 2017, right? There was the tax reform. The main thing that affected cost segregation is what's called bonus depreciation, okay? And it's going 100% bonus depreciation. And what that means is that the amount that you can accelerate, which we said the 5-year property and the 15-year property, you can accelerate that depreciation. So with bonus depreciation, it allows you to take that deduction within the first year of ownership. Instead of spreading it over 5 years or over 15 years, you can actually elect, you don't have to, you can elect to take either 100% or 50% of that depreciation in the first year of ownership. Wow.
And so let me think about how I'd form this question. If I own a property and maybe I'm still, I brought it before the tax code was put into place, and it's still within that time frame, and I've already done a cost seg study, can I go back and have that cost seg study revamped to include this?
No, because you can only do this within the first year of ownership.
Okay.
So, and the cutoff date, or the starting point date, was September 28th, 2017. So if you bought a property after September 28th, 2017, you are now eligible for this. However, if you already filed taxes on that property for the first year, you can no longer benefit. You can no longer take advantage of the bonus depreciation.
Got it. But going forward, this is a huge asset to have in your tool belt. So that's
huge. Absolutely.
We can talk cost segregation study, get into for days here. What would be some of the points that we definitely have to get across the board right now for people listening to the podcast? What would be one thing that maybe we haven't touched on, if there is any, that you would say that is something very important for the listeners to know about cost segregation?
Educate yourself. And this is really what, your podcast, and I love your podcast, you guys, you and Peely, like, you're just educating. You're telling real estate investors, or, whether it's aspiring real estate investors or whether it's, long-term seasoned real estate investors, you have to constantly be educating yourself, not only to, all the new things that are out there and happening, and there are a lot of changes constantly, like this new tax reform, but there's so many things that I'm constantly learning, so many different aspects of real estate that you have to kind of consider and keep educating yourself and learning. So cost segregation is one of those things, like you said, it's a bit complicated when you get into the nitty gritty. I'm not an accountant, I'm not an engineer, and so I could explain all the nitty gritty details, but in the end of the day, you need to hire an expert to kind of do this for you. Who is, a firm that is an engineer-based firm, has engineers on staff that are accountants that can comply with all of the rules and the guidelines set up by the IRS. So I think one of the things, and this actually, someone asked me this question just this week, can I do it? Is there like a do-it-yourself kind of cost segregation? Can you just, is there like a cheat sheet or, and the simple answer is no, because, obviously you can try, but if a person were to get audited, and God forbid, no one wants to get audited, but if a person were to get audited, it's for sure going to fail, because there's a whole guideline. And one of those things is it needs to be prepared, by an engineer, someone who is well-versed in the tax code of the cost segregation, the audit guide put out by the IRS. You have to comply with all of the, all the guidelines. And there's, hundreds of pages of like terse detail. And when we prepare a study, it has all of the, it can be 80, 90 pages of, just lists of all the assets and all the values, and includes all of the, rulings that the IRS put out, all the rulings that were gone through Congress about cost segregation, and put it together, and it's 100% recognized by the IRS.
Yeah, and a great point there. It's like if you're doing a syndication and you think you're going to draw up your own papers just to save you $10,000 and not think about the securities fraud that you might, or securities trouble you might get into 10 years down the road. Sounds good on paper, but ideally, the professionals are professionals, why they are, and yourself included. And a great point you made there is that when you're thinking about buying properties, you want to have your team members assembled, and a cost segregation company and person like Yonah, this is one of the people that you have to have on your team. So property managers, your brokers, your accountants, your insurance people, your cost segregation people. You have to have these people because they again, like, you may have never heard of this before and not doing it. You're doing great with your property, but now think about if you add this into your tool belt and put this with your property, how much more benefit you'll get out of your property. So, Yonah,
sure.
Awesome information. Thank you so much for today, and really appreciate it. And if our listeners want to reach out, find more, talk to you more about the studies, talk to you more about just your company in general, and just hear more about you, where can they find you?
Yeah, you can find me LinkedIn. That's a great place. I post there a lot. I'm very active on the platform. Great platform. You can find me. There's not too many people called Yonah Weiss out there, so I don't think you're going to miss me. You can reach me. My email is Weiss, first letter, first name, last name, at madisonspecs.com. That's our company. You can check us out on our website, Madison Specs. And, feel free to reach out anytime. Again, it's important to get an educated decision, right? Like you said, this is an amazing tool. So it can't hurt to look at the numbers and, run it with your accountants. And there are a lot of accountants, something I get all the time is, hey, my accountant's probably doing this for me, right?
Yeah.
No, the answer is no, probably they're not. And so why? Because they're not engineers. And so they need to engage your firm. And if they did, you'd know about it. right? Because they're going to bring you on board to teach you about it and to let you know that you're getting this extra benefit. So a lot of times they get that, oh, my accountant's probably doing this for me. Don't assume anything. You know, you want to educate yourself. You want to get the numbers. You want to see if it makes sense.
Yeah, absolutely agree. And definitely go on to LinkedIn, connect with Yonah Weiss there. He's got some great articles. He's posting great content, get you a lot more information on the cost segregation topic. And so, Yonah, thank you so much for today. It's really great to have you on.
Thank you. And thanks for having me right after, having a baby. That's, I'm sorry, Philly, obviously, for good reasons, couldn't join us today. But
we've had a couple of days in between, so it wasn't this morning. So that might have been pushing it a little bit. So, but Yonah, thank you so much. Again, absolutely grateful to have you on. This is a great topic, people. So hopefully people are going to take advantage of this and you're going to reap the rewards hand over fist. Again, this is Jason and Peely with the Real Estate Investing Foundation podcast. Thank you so much for listening. Have a great day now.
Thanks for tuning into the REI Foundation podcast. Check back next time for more awesome tips and strategies to launch your new you in real estate.